Amrita, which part of the micro matters now for weak oil? Which part are you studying?
China. I would say that's the number one concern in the market and a big driver of sentiment, not just in oil, right, across asset classes. But if you look at our balances, we have been, even here, we've been talking about, despite the weakness in European and kind of
Right.
US demand, it's Asian demand that's stronger. And our expectation has been that China will be recovering. Now, that's not quite happening.
We're expecting a lot of activities in the equities market. Looking forward to interest rates increase in the US, and the crypto market has a lot to look forward to also, with the much anticipated Ethereum Merge scheduled for this month, and lots of speculations on cryptocurrency prices. This month would play a very pivotal role in the outlook of assets investments this year. We have Raoul Pal again to take us through the rigmarole of the whole situation and help make sense of it all. Welcome to another exciting episode. Please take a minute to subscribe to the channel. We are happy to have you here. Now that you've done that, let's get on with today's video. M2 is a measure of money supply that includes bank deposits for savings accounts and all checkable deposit. The M2 money stock is important to all markets because it provides vital information on how much disposable cash is available to households, inflation forecasts, and interest rate forecasts. In the US, M2 records are maintained by the Federal Reserve, and they control the money supply that composes the M2. Money supply has picked up sharply since 2020, and we have a year-on-year increase of 5.28% in money supply in the United States, with an injection of about $1 trillion added into circulation already.
Well, inflation doesn't help because it's taking money from your pocketbook and not allowing you to allocate money into crypto because it's a retail-driven market. It also creates a lack of liquidity because the Federal Reserve, to stop the inflation, have been taking liquidity out of the system. So that means institutions and hedge funds have less liquidity to put into the system and therefore less flows into risk assets like crypto. I found the best approximation to be money supply growth, M2, year on year. And year on year M2 looks like it's potentially turning up global M2. We're already seeing that China is going to start picking up M2. We're already seeing that Europe is going to start stimulating through the back door, which is they're going to have to offset the electricity prices, the difference between electricity and gas prices. And they're also giving direct transfer payments to people to pay their electricity bills. So I think that monetary policy changes. It also lags ISM. It's kind of a weird thing. And it tells me that M2 bottoms right about now, which is what the crypto markets, I think, have been telling us. They're trying to find this bottoming process. And if I'm right, the economy slows down, liquidity is going to come up, and crypto is going to rally from here. Let's see. But again, I think crypto has put in a low. I think the ETH merge is a very big deal.
Yeah.
I think it's going to drive inflows. Yes, there'll be volatility. Yes, it won't be a straight line. But I think over time, it's going to put some security into the space because it's done and out of the way. Let's see. Let's hope there's no risk around this. It'll die some of the FUD narratives that are currently building as we move into this, which is only normal and people should question it. And then we'll see on the other side, when you've got this yielding asset that is a giant in the space, what that unlocks in terms of DeFi, the opportunities for institutions to invest, and other opportunities that come from a different asset. Also, the ESG credentials. We all know that Bitcoin ESG credentials are not what the ECB or others will tell you, but that's the narrative that's won the institutions now, that Bitcoin bad. But proof of stake, good. So I think all at the margin, it helps people allocate.
To control inflation and regulate activities in equities, the Fed uses quantitative tightening, QT, and quantitative easing, QE, and this is what players in the financial sectors watch and respond to. There's generally a concern that the Fed would call for more quantitative tightening, which would mean rates going up and unsettling the equities market. We have seen M2 growth slow down this year compared to 2020 and 2021. We have more money in the system than ever before, but the growth rate is actually slowing down this year. Raoul Pal believes we should expect significant leap in M2, which would free up funds that would stimulate the markets and even benefit crypto growths too, as people have access to more funds through the loans which would trickle into markets, such as cryptocurrency market. The much anticipated ETH merge is also going to bring some interest to the crypto market, and we should be seeing new investments in this space soon.
When the amount of money is growing, well, there's money everywhere. We can do stuff. Now, it means that it's easier to borrow money from your bank. It's easier to get a mortgage. It's easier to do all sorts of other things. But it also means that businesses have easier access to capital. Banks are not hoarding capital as much. So it means that money flows throughout the financial system. We're a system based on leverage and liquidity. So when money supply is shrinking around the world at the same time, it means that it's going to pull down all assets. And in fact, when we look at it, the bond market has lost $19 trillion in value globally. The equity market's lost $21 trillion in value, let alone real estate, crypto, all of these things. We've lost something like 40% of global GDP in this pullback. I mean, that's a lot of wealth that's been destroyed. And that's without interest rates getting very far. I mean, the US interest rates are 2.5% and bond yields are at 3%. But that's the problem of a leveraged market. So when you take liquidity away from a leveraged market, if you're paying the interest on your loans and you're not got enough money, so imagine you're trying to pay your mortgage, but your salary keeps going up and down. So i.e. the amount of money you've got is suddenly less, which is what's happening with inflation. It's harder to pay your mortgage. So you won't borrow or spend as much money. That's what liquidity does. So it's M2 is liquidity. Liquidity going up is good for assets. Liquidity going down is bad for assets. Liquidity negative, where it is now, has been particularly bad for assets, which is why we've had a bear market and we're pricing in a recession.
The IMF has come out with data to show that global GDP growth has slowed from 6.1% last year to 3.2% and would likely slow down even more next year to 2.9%. These growth constrictions are coming from the world's three largest economic areas: United States, China, and the EU. But with these three economies controlling the bulk of global economies, the effects would be global even for rapidly growing economies. The S&P Global Broad Market Index, BMI, is down 16.26% from last year, just as all major markets are also down. While the dollar is still growing strong, Raoul calls for caution, as he believes that the liability burden carried by emerging economies who have their liabilities in the US dollar would begin to react to this.
Currencies should not go parabolic, especially the largest currency in the world. It's a bad thing. And, I'm guessing that this is going to become a talking point for G7 nations, is like enough is enough. It's a big problem. Considering, for example, Europe imports oil. Japan imports oil. India imports oil. China imports oil. Oil is priced in dollars. And so they earn local currency and need to pay dollars. It's harder and harder to pay for. So it's bad.
The DXY, which is the currency exchange index that pits the dollar against other currencies, rose to 109.99, which is its highest since June 2002. While it is good for the US, it is not good for other economies, especially those who have to pay off liabilities with the US dollar. Oil is purchased and sold with the US dollar, which directly puts an FX burden on countries that have to buy oil. The People's Bank of China, PBOC, China's central bank, is already working with other central banks in Asia that would see then ditch the dollar for the renminbi. This would reduce dollar usage in payments across Thailand, Laos, Cambodia, and Myanmar. More nations are likely to follow if the current dollar valuation continues.